Hello traders, this is Blake Morrow with ForexAnalytix and you're listening to the week ahead video for February 27th, 2022. We're almost done with February and oh my gosh, it's the weekend and there is so much happening with headlines even over the weekend. All I'm trying to do is film this dang video and more headlines keep coming out. So just remember what's happening over the weekend is it's all a very fluid situation with everything that's happening in Russia and the Ukraine, which could affect the markets, which I'm going to talk about here in just a second. But before I do so, I have to mention, if you haven't tried out ForexAnalytix, try it out. It's $1 for 10 days. Jump in our community, check it out, download the mobile app, $1, 10 days, try out the entire program. Jump in our chat rooms. One of the best, most active trading communities in the markets. But if you want to try ForexAnalytix, and you want to get access to it, we have a new program. It's called the Trader Funding Program. We launched it last week. It is extremely popular. We have actually people that have qualified to access more amounts of money through the program. They've already gone through the assessment period. So check it out. It's been 1 week. It's really, really quite amazing. Click here to get started. Check out the Trader Funding Program. You have to pay an assessment fee, one-time assessment fee. You have to trade in a demo or paper trading environment. You have to hit a couple of benchmarks. Once you do that, with unlimited amount of time, if you pass, you can access a larger trading account. It's a pretty amazing thing that we've done for the ForexAnalytix community. I'm very excited to bring that to you guys and gals. Check it out. Just go to our website and you can go to traderfundingprogram.com. Check it out. All right. So let's get into the markets. Let's get into what's happening and talk about everything as of right now during the time of writing. So first of all, if you guys haven't seen the headlines, basically the EU, the UK, US, Canada, they all pledged to remove select banks out of the SWIFT banking system. So the SWIFT banking system is an electronic system. I believe it's based in Belgium. It connects like 11,000 financial institutions. And it basically, by cutting Russia out of that, those banks can't access international funds. They're doing this as part of their, the methodology to get Russia to basically stand down. A lot of people are saying over the weekend that there's going to be some risk off because of this, which is entirely possible. But I'm filming this on a Saturday and the market's open on a Sunday, so we'll see how the market's open, but a lot can happen in 24 hours. And if you're Russia, you had to have, Putin's not a stupid person. We all know and understand this. So I'm sure they saw this coming. And their response, they probably have their, planned response of 7 to 10 to 12 different steps ahead of what they're going to do anyway. My opinion is basically within the next 24 to 48 hours of the time of me filming this, you might actually see a de-escalation of Russia as they might pare back as they probably anticipated all of these sanctions and being removed from the SWIFT system and some of these golden passports being removed so Russian oligarchs can't access financial systems through other countries. I'm sure all of this has already been thought through. So before you get too terribly excited about what's going to happen Sunday night, Monday morning in the markets, take it all into account. Realize that, I'm sure Russia's not sitting there going, oh, I can't believe they just did that. Of course they're not thinking that. So the question is, what is the response going to be? Is it going to be, standing down, pulling back troops? My opinion has always been, and if you listen to the daily F.A.C.E webinars, that Russia's going to go 2 steps in, 1 step back, 2 steps in, 1 step back. So 2 steps in, they might pare back a little bit, but they've moved the goalposts a little bit. You know what I'm saying? So we'll see. Let's just hope it all de-escalates and the markets can regain composure like they did going into the end of last week. So let's talk about what I think. Just going, if you're watching this over the weekend, which you might be watching this on Saturday night, Sunday morning, whatever the case may be. Keep an eye on Bitcoin and Ethereum. Those are the two cryptocurrencies. They are obviously not risk on, risk off tools. Well, they are. They're not risk aversion tools like some people believe. They tend to move with risk, and they move when there's risk aversion, they move down. When there's risk appetite, they move up. So when that headline came out, or when these headlines came out over the last couple hours, and I'm just showing you Bitcoin really quick, you can see how it moved down a little bit. So there's some selling in these quote unquote riskier assets as of right now. And I'm just showing you an hourly chart based on the last couple hours of these headlines coming out. Now, by the open, what I would be watching is just seeing how these cryptocurrencies are moving. They're probably going to tell you if they're moving higher, then the situation seems to be getting better. There's probably some news or headlines that are supporting that. And if they're moving lower again, then we know that the markets are going to come under pressure whenever the markets do reopen, especially futures markets reopen Sunday night. So just keep that in mind. But another thing we need to really keep in mind is look at the massive reversals that we saw in the equity markets. Look at the S&P, and let me remove this AB equals CD that we had mapped out, okay? The thing about the stock market is we had a huge hammer on a weekly chart. The reason why you should pay attention to this, because if the markets gap down on Monday or Sunday night, Monday morning, the markets come down and we see the markets reverse a little bit. And I'm just going to draw this out for you. You probably want to be a buyer of dips because this is such a big weekly hammer that you're going to get buyers on dips now. There are people that are caught short. They don't want to be short and they're going to be buying dips. We probably will see that in all the markets. If you look at, here's the S&P. Let's take a look at the Dow. Look at that huge hammer on a weekly chart of the Dow. The Nasdaq, huge hammer on the Nasdaq. Those, you have to respect them. And remember, it's a weekly chart. So just one day is not going to make a week. So if the markets do open lower Sunday, Monday, maybe we trade a little bit lower Monday, Tuesday, based on what we're seeing here technically, you probably want to be buying those dips. Now, obviously, this is a headline-driven market. So trade small, know your risk, reduce your risk by trading smaller, keep your stops in place, and if you get stopped out, it's not going to hurt that bad. That's the best kind of advice I could give you as a trader because I can't tell you what to do, but I can at least suggest that you trade in a smaller position so you reduce the risk of whatever you're trading. In a highly volatile market, that's what you should be doing anyway as a trader, okay? So I just want to give you a little heads up on what's happening with the actual broad markets. But let's look at crude oil. What a massive reversal. We had 161% extension, hit the channel top right at 100. Bing, hit the bell and reversed. We came down to channel support. Everybody in the ForexAnalytix community knows that if we break 90, 89, the markets are probably going to come under pressure, or at least the crude oil markets are going to come under pressure. We're going to see some of that strength abate a little bit, take us back towards 85. Be watching around the $90 mark in crude oil. Watch it carefully because if that breaks, crude's going to come under pressure, and that might allow for the dollar Canadian maybe to, push lower, the Canadian dollar to push lower. Maybe the dollar Canadian will stabilize. By the way, the dollar Canadian is in very, very messy territory. If you guys are, super excited about trading the dollar Canadian, I can't even figure out why. And on top of that, we don't even have Canadian jobs this Friday. We do have U.S. jobs report this Friday. Canadian jobs report, not so much. So I don't know how I'm supposed to get excited with the dollar Canadian boxed in between the 200-day moving average and this one, 29.50 level. If you guys figure it out, let me know. Jump in the comments below and tell me how you're going to trade the Canadian. All right, let's take a look at the euro dollar. Now, the euro dollar has been all over the map. I'll tell you this. Me personally, I bought the euro on the dip. And then it kept dipping. And it dipped and it dipped a little bit further. And I finally got out of my positions like this. All right. So the euro, let's not forget, let's go to the weekly chart and let's zoom all the way out really quick. And I'm going to just show you. You take this high, all-time high. Well, not, yeah, it is all-time high. Now I'm thinking about it. Back in 2008, the high in 2011, the high in 2014, the high in 2018, the low, October 2020, then the low back here in December. You guys know I was buying back in December. Go watch the week ahead video from a couple months back. And where we're at right now. Where is that? Well, we basically tagged that trend line once again and then bounced. So that is a stark reminder that that weekly trend line sits just below where we're currently at. So any dip that we're finding down towards 111 is still being bought several weeks later. If you're short euro, you should be thinking about that. Now, the flip side to that is if we ever break, like let's say 110.50 or 110, the euro is probably going to come unglued to the downside. Now, you might be a dollar bull, you might be a dollar bear. I'm not so much in the dollar bull camp, not while the euro is trading above 110.50. However, we get below the 110.50 level, I will be singing a different tune. Watch me, all right, if we ever get there. You also have to take a look at the dollar yen. You know, people have been looking at the dollar yen thinking, wow, okay, there's risk aversion. Stocks are coming, last week they were coming under pressure. You're trying to buy yen as stocks are going down. And then soon as stocks pop back up, dollar yen pops back up. We're following an ascending channel right into and you guys heard me talk about this last week. That's where all these drawings come from. You heard me talking about a multi-decade trend line also coming in at 117. If you're not aware of that, be aware of it. I said multi-decade. It is 1998, 2015, and then where we're at 2022. If we ever break 117, the last place, in my opinion, you're going to want to be is long yen. Okay, that's it. Pretty simple. Now, that also means that should we get to 117, that's going to be major resistance. You guys know that I think if yields rally, if the 10-year yield continues to spike higher, if that happens, it's going to take us right to 117 and some change. And then at that point in time, it's going to be do or die for the dollar yen. It's probably going to be do or die for the yield for bonds at that point too. That would be my best guess. Now, a few other things that are happening next week. So let's just talk about it really quick. We have the Rba Rate Decision. Now, I have been pretty vocal about my bullishness in the Aussie ever since we tested 70 cents. I went long right at 70 cents. You guys probably remember that if you were watching the week ahead video, if you're watching the F.A.C.E webinars on a daily basis, any of our ForexAnalytix webinars that we do every day, or on the trade-off that I do with Pepperstone Securities and Chris Weston. I was very vocal about being bullish the Aussie dollar as we approach 70 cents. I got long at 70 cents. And look, I continue to be an Aussie bull while we're above 70 cents. Now, we ever get below it and we stay below it, again, my tune might change a little bit. But we got to watch the Aussie dollar because we are in a high inflationary environment and it's not acting like a risk-off vehicle. We talk about this on a daily basis, but the dynamics of the way the Aussie and the Canadian and the New Zealand dollar are changing. And you have to keep that in mind when you're talking correlations in the market. We are in a much different market today than we were 10 years ago. So for those of you that are still set in your ways thinking that Aussie dollar risk off, it goes down, risk on, it goes up, those times are changing. It's, the thing about correlations in the market, it's not a on-off switch. You don't just flick it on, flick it off, flick it on, flick it off. It takes time for these correlations to change. And like I said, we are in a very, very, well, you could argue a cyclical bullish commodity cycle. Did I say that correctly? Cyclical commodity bullish cycle? Cyclical bullish commodity cycle? Bullish commodity cyclical cycle? bicycle, unicycle, cycle. Shoot, I don't know. But you guys get what I'm trying to say here is that we are in a much different environment today than we've been in the last 10 years or 20 years. So now these commodity currencies like the Aussie, the Kiwi, the Canadian, they could, some people might even view them as safe haven currencies. I don't know. We'll probably be finding that out over the next few months, but I will tell you this, they are not acting like they used to, so you can't treat them the same way you used to. I hope that makes sense to all of you guys and gals out there. Now listen, one other big development happened this last week, and then before you go anywhere, let me just say this. If you have something to say, if you have something to add to this conversation, please jump in the comments below, right below. And then also, if you like this video, please give us a thumbs up. It is Saturday. I'm here doing this for you. The rest of our team is working behind the scenes, putting this out on social media, doing the editing. We really appreciate your thumbs up. And we really appreciate if you subscribe to the YouTube channel down below. It's free to do that. So just subscribe to the channel. Thank you very much. I do appreciate each and every one of you for listening in every week. All right. Now, one last big development that happened this last week. Gold. Holy mackerel. We had this huge rally out of a triangle. Now we had this, big double bottom. I was actually, as that candle was green intraday. So this candle right here was bright green. If you don't recall, man, that thing was like Christmas tree green. It was like super thick. It was like boom, it looked like at that point in time when I'm, mapping this out for you, we had a big breakout, double bottom, gold's on its way to 2150. Holy cow, we're going to go so much higher. And then by the end of the day, it reversed its course and closed back below 1915. And I have to say that it probably crushed everybody who was short and it got everybody long. When you see developments like that intraday, what that means is all the longs were cut short, all the shorts were cut, they got out, they got stopped out. And then you got longs that piled in the market thinking, all right, here we go. We're going back to all-time highs. They got crushed the following day. Now the risk is if we break back below 1880, which is right here, which, by the way, we closed basically on 1880. We start trading below 1880 and definitely 1850, like right here. The risk is we're going to break down. So you guys that know me, you've heard me say this a zillion times. False breakouts lead to breakdowns. False breakdowns lead to breakouts. So we had a false breakout. There's a high possibility that we break down. Now, there's a lot of work for this to do on the downside, but I'm speaking to all of you guys that are gold bulls. Look, I own gold personally, physical, in the safe. I'm not trading it right now, but I own gold. I would love to see gold go to 3,000. I'd feel good. That would be great. But I'm going to tell you guys guys and gals, if you are gold bulls and you are just, balls to the wall long, you have to be really careful here because this is the point in the market where you could see it reverse in an aggressive manner. And there could be a multitude of reasons why that happens, whether it's a de-escalation. We've seen inflation peak, here in February, and in March we start to see, maybe some deflationary pressures come up. I don't know. You guys can come up with A, B, C, and D, and E, and all the reasons why, but I think you have to be really careful about that big reversal. That is, to me, that's scary. When you see things like that, that means that it caught a lot of people wrong-footed on both sides. And then the reversals tend to be really quite nasty. So, if you like this type of content, make sure you listen to our webinars. We do them every day. They're free. The F.A.C.E webinar is free every day. 30 minutes, myself, the rest of the ForexAnalytix team, or at least a few of the ForexAnalytix teams there, giving our analysis on the markets. Dale Pinkert does wonderful interviews with industry experts every single week. Then we have, private webinars like the European crossover, the daily roundup, the morning edge. All of those are for ForexAnalytix subscribers, but at least you can come catch us every day for free. We've been doing it for 5 years now. So make sure you join in. My name is Blake Morrow. I want to thank you all for joining me today. Thanks for spending your time with me. I do appreciate it. And I'll see you guys on Monday. Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.